Welcome to the Gold Market Review for February 13th, 2026. Today, we dive into the current status of the gold market, analyzing key indicators, policy environments, and technical levels. Before we begin, please remember that this content is for educational reporting only and should not be considered financial advice. Let's start with our market overview. As of February 13th, 2026, gold prices show volatility, but remain moderately supported near the key $5,000 level. Spot gold is trading around $5,007 per ounce, having recovered modestly after recent dips. The ability to hold near the psychological $5,000 mark reflects continued safe haven demand. Moving on to key macro indicators and the policy environment that are driving today's price action. The US dollar has stayed in the mid-90s, while the 10-year Treasury yield continues to trade in the low 4% bracket. This complex backdrop balances gold support with factors that limit dramatic surges. Recent softer inflation data eased rate hike fears, but strong labor figures keep tightening expectations alive. This tug-of-war in forecasts creates nuanced positioning for gold. Now, let's examine the technical perspective to understand the short-term direction of the gold market. Momentum indicators suggest the gold market is consolidating rather than breaking out sharply. Oscillators remain near equilibrium, indicating a balance between buyers and sellers. From a technical perspective, the intermediate support zone lies near $4,950 to $4,980, where buyers have recently defended price action. Immediate resistance clusters above $5,030 to $5,070, where meaningful selling pressure has emerged. Traders are watching these levels closely for the next move. Finally, we consider the underlying structural factors related to global trade and supply that influence bullion pricing. Persistent physical demand from major consuming regions and strategic reserve accumulation continue to contribute to price support, offsetting short-term technical pressures. Central banks and institutional investors diversify into gold as a hedge against currency risk and geopolitical uncertainty. This deeper structural demand helps anchor gold's price. To summarize today's analysis, we recap the key takeaways defining the gold market. The gold market balances macroeconomic influences with technical pressures near critical levels. Currency strength, yield dynamics, and underlying demand will continue to define its behavior. Thank you for watching this educational gold market review. Subscribe for daily market reports, and remember, this is for educational reporting only, not financial advice.